Before I begin the video, Before I begin with the video, notes will be added in the description when I get time. And videos are organized in two parts. First is primary. Here I avoid going to too much into unnecessary details or covering too much into unnecessary points. I will avoid any difficult derivation if possible, and then I on if I need that there is a need for a second video, I will add it in appendix. So the primary video will help better to conceptualize the topic and help keep the attention span. So let's start with the introduction for this chapter. So the theme of this chapter is based on the idea that countries with higher GDP growth rates tend to have better investment opportunities. For example, we are given with the GDP growth rates for India and USA. India's GDP growth rate is more than that of USA, so investment opportunities available in India will be better than that of USA. So what the real GDP does is that it measures total output of goods and services produced in an economy during a given year. The growth in real GDP shows economic expansion. There is another concept which is real GDP per capita, in which the real GDP is divided by the total population of the country. A growth in real GDP per capita shows improvement in standard of living of the people. We can categorize developed versus developing countries based on the level of real GDP per capita. Developed countries are countries with high real GDP per capita, and developing countries are countries with low real GDP per capita. Now let's get introduced to the concept of potential GDP. Potential GDP represents the maximum level of sustainable GDP of a country. The key word here is sustainable. So if we were to make a graph in which real GDP is measured across time, in this the curved line is the actual GDP which tends to move in cycles, and the linear line is potential GDP. When the actual GDP is more than potential GDP, we have the upward phase in business cycle, and when the actual GDP is below the potential GDP, we have the downward phase in business cycle. In this chapter, we are concerned with potential GDP, which represents the maximum level of sustainable GDP for a country. Now let's study what are the factors which favor and limit economic growth. The first factor is availability of capital. Capital is essential to improve the productivity in an economy. So what are the sources from which we could get the capital? First is high saving rates, and second is high foreign investment. So higher savings translate into more investment, which translates into higher capital. In many poor countries, there is a vicious cycle where savings rate is low. That's why there are fewer investments and the capital is low, which results into a lesser output, which in turn results in lesser savings. So that's how there is a vicious cycle. So how can this vicious cycle be broken? It could be broken by higher savings rate or higher investment from foreign countries. Also, we can distinguish countries based on capital per worker as developed or developing. Developed countries has high capital per worker while developing countries has lower capital per worker. If a country has well developed financial market and intermediaries, It contributes towards economic growth. So how financial market contributes towards economic growth is it allocates capital efficiently, encourages saving by creating investment instruments, and the third point is makes it easier for companies to raise capital. If a country has political stability, upholds rule of law and property rights, then it attracts more investments. Property rights provides an incentive to invest and to save, and the rule of law helps to enforce those property rights. Political stability in a country is viewed as positive by investors as it means consistent regulatory environment. Next point is on education and healthcare system. A well-educated and healthy population contributes to the economic growth of a country. Here, education refers to both formal education and on-the-job training. Education could be at primary and secondary level or university level. So it is noticed by studies that developed countries benefit the most when they invest in education at university level, while developing countries benefit the most when they invest in primary and secondary school education. The next point is about tax and regulatory systems. Lesser tax and fewer regulations tend to promote entrepreneurship and entry of new companies in the industry. Next point is about free trade and unrestricted capital flows. A country with a free trade and unrestricted capital flows tend to attract more investments, hence higher economic growth. With free trade, there are a couple of points. Low tariffs on imports allows to import capital goods and hence new technology comes to the country, while residents of the country also benefit from wide array of goods and services. Unrestricted capital flows can come in the form of investment in plants, equipment, investment in plants and equipment in the form of FDI or investment in stocks and bonds in the form of FPI. Both these increase the level of investments in the economy and can help them break the vicious cycle of low saving rates contributing to low output in an economy. In developed countries, we often have higher availability of capital, well-developed financial market and intermediaries, presence of political stability, rule of law and property rights, well-educated and healthy workforce, lesser tax and lesser regulations, and free trade and unrestricted capital flows, which contributes to their economic growth. However, in the case of emerging market countries, many of these conditions might not be true. Let's start with the section why potential growth is important for equity and fixed income investors. Let's first start with the equity investors. Now, let's start with the topic of why potential growth matters to investors. Here, by potential growth, we are mentioning the growth rate in potential GDP. So, for equity investors, by equity investors, here we mean investors in public equity. Private equity does not count as equity investors in this topic. So, first key idea from this passage is the potential GDP limits earning growth. Now, how do we come to this conclusion? Potential GDP places a limit on actual GDP. Because the actual GDP is above the potential GDP, then the central bank pushes the interest rates upwards, which causes actual GDP to fall below potential GDP. The second thing here is that companies' earning growth can be greater than growth rate in potential GDP if profits to GDP ratio keeps going up. However, it cannot keep going up because of stagnant labor income would mean that demand for goods and services will fall in the economy, and as a result, sales of companies will fall. So the profits to GDP ratio cannot keep going up. So let's understand the Grenard-Kroner model. It explains expected return on equity as a function of dividend yield and capital appreciation. Capital appreciation is broken into two parts. First is first is change in price to earnings ratio and second is growth in earnings per share. So how does capital appreciation, which is change in price, equals to change in PE plus growth in EPS? So we had studied in equity that price equals to price to earnings ratio multiplied by EPS. Similarly, mathematically it could be derived that percentage change in price equals to percentage change in price to earnings ratio plus percentage change in EPS. Now this growth in EPS number could further be subdivided into inflation plus real per capita GDP growth minus change in shares outstanding. So the next idea is if GDP is going up, then it does not automatically translates into stock returns going up. As we have seen, this I plus G component in the formula represents the nominal GDP. So if GDP is going up, it does not mean the stock returns automatically goes up. This is because of this delta S component which consists of net buyback plus relative dynamism. If there is a net buyback, that means there is fewer number of shares outstanding and hence it contributes to the equity return. But if there is an issuance, then it reduces equity return. For relative dynamism, all growth in GDP does not come from public equities. Growth also comes from private small firms not listed on stock market. So that this component is subtracted from this I plus C. Here in curriculum we are given few examples in which how real GDP growth substantially differentiates from real return it is shown. So here the real GDP growth is 8 to 8.2% compared to 0.7%. In this 8.2% net buyback, we need to add up minus 26.5% and relative dynamism component is 14.9%. So as a result, this number is going to reduce. And in this case as well, this number is going to reduce the real return in local currency. So GDP going up does not automatically mean that stock returns are going up. It contributes, does not necessarily that GDP goes up, stock returns goes up. Why? Because there is dilution, there is privatization, which both component contributes to net buyback going up, so it contributes negatively to equity return. measured by delisting going up and market composition also going changing. Market composition by all the firms are not our firm are not publicly listed, so RD component as well. So how does potential growth affect fixed income investor? First is it leads to high potential GDP growth causes because it high potential GDP growth can cause high real interest rates, which could lead to higher expected real asset returns. High real interest rates are part of high real expected returns. It could lead to improvement in sovereign debt rating for a country. It could lead to improvement in credit quality of fixed income securities. Also, the potential GDP growth impacts the understanding of investors about inflation, as inflation is indicated by differences in actual and potential GDP. So it helps investor to gauge the level of inflation. It helps investor to cost the future monetary policy based on whether the economy is overheated or underheated. Central bank will take the necessary corrective action, and in also it helps us to gauge the fiscal policy as well. So by paying attention to these three things, we could better manage a portfolio of fixed income securities. Now let's come to the topic of determinants of economic growth. Here we are going to be introduced with the concept of production function. This is the general equation for production function. It says output equals to A into function of capital and labor. So A stands for level of technology in the economy. K represents the level of capital in the economy. Or to describe it further, it represents the level of services provided by the capital equipment. L represents the number of labor hours worked. We need to know a specific form of production function called Douglas production function as well. Here the interpretation of Y, A, K, L will be the same. Here the interpretation of alpha is it is the share of GDP which is paid to the suppliers of capital. GDP can also be referred to as total output or total income. And 1 minus alpha is share of GDP which is paid to the labor. What are the features of Cobb-Douglas production function? First is constant returns to scale. If we increase all inputs exactly by the same percentage, then output will increase exactly by the same percentage. For example, if you are going to increase capital and labor both by 5% each, then the output is also going to increase by 5%. And the second feature is diminishing market productivity with respect to each individual input. Let's say if we keep the capital constant and in this graph increase labor by 1 unit, then output will increase. It will keep increasing at a slower rate until there comes a point where an additional unit of labor contributes to fall in output. So this is known as diminishing marginal productivity with respect to each individual input. Now let's come to the topic of labor productivity and original production function. If we divide both sides of the equation with labor, then we'll get an equation something like this. Output per unit of labor equals to level of technology economy multiplied by function of capital per labor, comma 1. Output per unit of labor could also be denoted by small y, and capital per unit of labor could also be denoted by small k. So, considering these changes, Cobb-Douglas production function expresses labor productivity as A into K raised to the power alpha. Alpha is same as share of GDP paid to the suppliers of capital. Now let's come to the growth accounting equation. The Cobb-Douglas production function could be mentioned in a different way like this. This equation on left hand side we have change in the rate of output equals on the right hand side change in the level of technology plus alpha into change in rate of capital plus 1 minus alpha into change in the rate of labor. I have also provided this equation in written form here, where I have expressed it as growth rate of output equals rate of technological change plus alpha into growth rate of capital plus 1 minus alpha into growth rate of labor. This equation can be derived from Cobb-Douglas production function, and this equation deals with the percentage change. What could be uses of this equation? This is an exogenous variable. So if we know growth rate in output plus alpha into growth rate into capital plus 1 minus alpha into growth rate in labor, we could plug these in this equation and determine the level of technological progress. Or in other words, I could also say that level of growth rate in technology. Second use is it measures growth contributed by each source. So if we are given a growth in potential GDP figure, we could see that how much of growth is coming because of technological change, how much growth is because of growth rate in capital, how much growth is coming because of growth rate in labor. Its third use is it measures potential output. So if we know last year's output, we could calculate the change in output for this year and we could add last year's output with change in output in this year to calculate the total output this year. Now for this equation we could also express it differently. It, it says growth in potential GDP equals long-term growth rate of labor plus long-term growth rate in labor productivity. Basically what has happened is we are calling these two terms combined as long-term growth rate in labor productivity. We can verify this from here. Here, if we were expressing labor productivity equals to A into K to the power alpha. So this was the Cobb-Douglas prediction for labor productivity. On expressing in a similar percentage terms, it becomes something like this. Okay, so what all formulas we have seen on this side? First is for production function and Cobb-Douglas production function. Second is output per unit of labor plus out plus unit labor expressed in terms of Cobb-Douglas production function. Third is growth accounting, in which we have expressed rate of change in output as a function of total factor productivity, capital, and labor. And fourth formula here we have expressed as growth rate in potential GDP as a long-term growth rate of labor plus long-term growth rate in labor productivity. Okay, now let's come to the topic of capital deepening versus technological progress. We have earlier studied the concept of diminishing marginal productivity in a production function. Here we have shown in the graph Cobb-Douglas production function expressed with respect to labor productivity or per unit of labor. So we have output per unit of labor on y-axis and capital per unit of labor on x-axis. As we keep a constant level of technology in the economic constant and increase capital per labor. Initially, we get increasing return, then those returns increase by smaller size, and then there comes a point where on increasing additional capital per unit of labor, output per unit of labor goes down. So we cannot grow output per unit of labor with respect to by increasing only capital per unit of labor only. For increasing output per unit of labor, we need improvement in the level of technology in the economy. So, if the level of technology in the economy goes up, then this curve as a whole shifts upward. The same labor, we are able to get higher unit of output per labor. One important conclusion which we get from this graph is that output per labor is same as GDP per capita. So, in developed countries, what happens is there is already a very high amounts of capital per labor invested. So, if developed country wants to improve its increases GDP per capita, then it has to do so by achieving growth in the total factor productivity, or as you call it, growth in the level of technology. Okay, now let's come to the topic of extending the production function. Till now, we have seen a basic production function in which the only inputs were labor and capital. So, what an extended production function, we have divided capital into human capital, information computer and telecommunications capital, which is denoted by symbol KIP. KNT stands for non-ICT capital. We separate this because impact of ICT capital of information computer and telecommunications capital is quite substantial compared to regular equipment. Then we have public capital. This is the capital and infrastructure owned by the government. Here in this equation, N stands for natural resources, or you could say raw materials. A country with a healthy workforce free from diseases tends to perform better than compared to a country which has invested less in healthcare. And A stands for technological knowledge. Let's start with discussing each individual component of expanded production function. First is raw materials or natural resources denoted by N. For a country to grow, access to natural resources is important and not ownership. It is important to note that, for example, countries like Japan and Singapore have very less natural resources available, but these countries can import natural resources. So the ownership of natural resources does make a country richer, but could it drive economic growth for a country? Answer is that ownership of the natural resources does mean that the country have access to those resources, but in few cases we have seen that presence of natural resources can also limit growth. For example, there might be a situation where necessary economic institutions have not been developed. Presence of natural resources have made the country richer, but economic institutions which are needed for growth are not developed. Second refers to a situation known as Dutch disease, in which export of that natural resources makes the currency appreciate in value. So it makes manufacturing globally uncompetitive as other countries will find it expensive to buy the product. Now there is one more question as non-renewable resources. Non-renewable resources are like oil, fossil fuels are depleting. Will it limit economic growth? So the answer to that is no, because as these resources deplete, the price of these resources will go up and naturally other substitutes will be developed. Plus, in developed economy, where we are seeing a trend that there is increasingly less dependence on non-renewable natural resources. For example, petrol, which used to be used in cars, is being substituted with electricity or solar energy. Second factor is labor supply. Growth in labor supply depends on following factors. First is population growth, birth and death rates in a country, and it is to be noted that the population growth in developing countries is much more than the population growth in developed countries. Another thing is that by population here we are concerned with working age population. So if working age population is increasing, that is good for the total output of the country. Our second factor is labor force participation rate. So labor force participation rate represents how much people are working in the percentage of working age population. So let's say if there is a country in which women are out of the labor force, but there is a trend where women are slowly starting to join the labor force and it is expected to continue, then it will be seen as a positive and will increase the labor force participation rate. Also note that a country cannot sustainably increase output through increase in labor force participation rate as it is not sustainable after some point. Third point is net migration. Countries such as Canada, Australia have a very less rate of population growth, so they rely on migrants to fill in. Countries with positive net migration is seen as contributing to labor supply and hence contributing to total output of the country. The fourth point is average hours worked. This is business cycle dependent in stages where we have upward stage of business cycle, the average hours worked is generally more than where we have a downward phase of business cycle. And the second point is there is a trend toward shorter work week in more advanced countries. For example, 4 days work week. Now let's talk about labor quality, which is human capital, denoted by H. Education on the job training are expensive, but studies have shown that countries which invest heavily in these tends to do better. Also, it has a positive externality impact as well, as people who are well educated and well trained also improve the performance of others around them in the workforce. And also, when individuals are well educated and well trained, they can engage in innovation and research work. Plus, well educated individuals are better able to make use of the capital stock which is provided to them. And also, a related point to the education and on the quality is healthcare. So, next point is capital. It can be divided into information, computers and technology, communication, ICT. and non-ICT capital. ICT capital is denoted by KIT and non-ICT capital was denoted by KNT in our production function. So the physical capital stock of a country rises if net investment is positive. And there is a high correlation between investment and GDP growth rate. Historically, it has been seen that companies which invest most, like India, China, and South Korea, have comparatively high growth rate of GDP. Now, here it is an important point to note. In capital deepening conversation, we have seen that when we only invest capital, then output per labor falls at some point. But for countries like India, China, or other emerging countries, investment-driven growth can last long, especially because these countries the starting point of capital to labor ratio is quite low. The physical capital can be divided into ICT and non-ICT capital. In ICT capital, there is high network externalities. So by high network externalities, you mean that it is less susceptible to situation of capital deepening, while non-asset capital regular equipment is more susceptible to capital deepening. Now let's talk about technology, which is denoted by a symbol A. It refers to advancement in science, technology, or improved management methods. It could be reflected through better human capital, better public capital, or better ICT or non-ICT capital. In technological progress, we have more better output with the same level of input. Because here the whole production function goes up as a result, GDP per person goes up with same level of input and it helps to remove the effect of diminishing marginal returns to capital. So that's why we also say that production function as a whole has gone up. Now let's come to our next factor, which is public infrastructure denoted by symbol KP. It includes roads, bridges, municipal water, dams, etc. Public infrastructure complements the production of private sector's goods and services. If there is a better road, better bridge, or better municipal water, private sector is able to perform better basically. And the curriculum mentions just like research work has positive externalities, public infrastructure also have positive externalities. So let's start with this new topic, theories of economic growth. So let's start with this new topic, theories of economic growth. So what do we mean by word theory? Theory means explanation of how something works. So here we are looking at theories which explain economic growth. There are three theories of economic growth. First is the classical model. It was developed by an economist named Malthus, and it is also known as Malthusian theory. It was developed in the year 1798, and one thing to note about this theory is it was created at the time when the economies used to be primarily agricultural based economies. So, this is a fairly old theory, and this capital is not even an input. Here, the only relevant input is labor, and we do have diminishing returns with respect to labor. So, as we add labor, initially the output will go up, but if we keep on adding labor, the output will increase at a diminishing rate. In this theory, there is a concept of subsistence level of output, which means the minimum level of output or income which is needed for people to survive. So, if there is a technological innovation Let's say there is a better regulation system created, then it will increase the GDP per capita, or you could say GDP per person. For the same amount of labor, we will be able to generate greater output. So, if there is a technological innovation, GDP per capita rises. This results in a explosion. As people have more food, they have more babies. So that brings GDP per person back to the subsistence level of output. So what does this classical model predict? First is that growth in GDP per person is temporary, and second is in long run, technological innovation leads to a larger but not a richer population. Historical evidence does not support this theory. Over the past decade, we had seen that GDP per capita has consistently risen for few countries while population growth has slowed down. And the improvements in technology has offset diminishing margin returns of input factor in production function. Next, we come to neoclassical model. This was developed by Robert Solow and is based on Cobb-Douglas production function, which we had just discussed before. Here, the objective is to relate long-term growth rate in GDP per person to savings/investment rate of technological change, and population growth. So, this statement, I will say it is not comparatively that important, but just I have mentioned this. This model, it is important to understand the concept of steady state. All the developed countries are at steady state and developing countries are moving toward a point of steady state. So in steady state, what happens is that GDP per person and capital per person grow at equal sustainable rates. And also in steady state, output to capital ratio remains constant. So there are three important formulas we need to know regarding neoclassical model. First is long run growth rate of GDP per person, or in this case you could also say capital per person. As we have discussed, these are both the same. So let me just show how this formula is derived, even though this is not important and testable. This theta is same as the A we have studied before and it represents technological progress. And alpha is also same as share of GDP going to the providers of capital. So in the previous slide we have seen the simple Cobb-Douglas production function could also be expressed in this manner, in growth accounting manner. So for this labor productivity function we could also express in growth accounting manner. This would look something like this. So in steady state as growth rate of y to l and k to l is the same, so we could mention this as one only. So what will happen is K12 will be replaced by Y12 in this equation, and we could take Y12 common, and then the value which we get of Y12 will be this. Now the next formula is growth rate of output, which is growth rate in GDP. In last slide, we had seen this formula where the growth rate in potential GDP was expressed as sum of long-term growth rate of labor and long-term growth rate in labor productivity. So this theta divided by 1 minus alpha is same as long-term growth rate of labor productivity, and this n represents growth rate of labor. Now the next formula is about output to capital ratio. It is denoted by this Greek letter. And how how do you remember this formula? First is remember this formula, then add this Greek letter. This Greek letter represents depreciation rate in the overall economy. And this whole term is multiplied by 1 divided by savings rate. Now let's come to the predictions of new classical model. With respect to developing economy, a developing economy will move to the point of steady state. What happens with respect to capital accumulation? So we are going to experience diminishing marginal returns. In short run, GDP per person ratio can be greater, but in long run, GDP per person grows at the rate which is suggested by this neoclassical model. So the capital accumulation impacts the level of output. Like it leads to higher output, but it does not influences the long-term growth rate, which is this predicted by this output by this formula. Next point is about convergence. So the GDP per person of developing and developed countries should converge. So what happens is if a country is at a steady state, then the capital accumulation does not lead to increase in GDP per person. But if a country is not at a steady state, let's say at a point below the steady state, then that country can experience higher growth in GDP per person as the country experiences more and more capital accumulation. It moves to a point of steady state where the GDP per person of developing countries catches up with GDP per person of developed countries. Our next point is about developed countries or the countries which are in already in steady state. So capital accumulation has no impact on growth rate or the marginal product of capital in these economies. Here growth rate is of GDP per person. So as we are already at a further point on this curve, increase in capital has no effect on the growth rate in Y to L ratio, which is GDP per person ratio or the marginal product of capital. Only way to have sustainable growth in GDP per person is through technology. Next topic is effect of savings on growth. So during transition for a developing country, if there is higher savings, then it will lead to higher investments. So higher investments mean we are increasing the capital. So the capital to labor ratio will grow up, and as a result, resulting output to labor ratio will grow up at a high rate. So this growth rate in GDP per person exceeds the growth rate which should be predicted by the steady state, but this happens only till transition. In steady state, if we increase savings, then the investment will rise as the capital will rise. So it will lead to higher capital to labor ratio. And this will result in higher output per person ratio. Now, this is not to be confused by diminishing marginal returns, as this increase does not have any impact on long-term growth rate of GDP per person or capital per person. So, just to give an analogy here, so if let's say if we are traveling at a speed of 50 km per hour in the steady state, but due to increase in savings, we increase to a speed of 60 km per hour, but this is temporary. In long term, we will return to the speed of 50 km per hour. Now let's come to the limitations of neoclassical model. Here the first limitation is that the impact of technology is treated as a residual, and the growth in developed countries is majorly attributed to total factor productivity. So we had already discussed this point that we can use this Cobb-Douglas equation to estimate technological progress. So that also becomes a limitation as well. Second limitation is that savings and investment have a temporary impact and does not impact the long-term growth rate in GDP per person. But studies have shown that higher savings or higher investment leads to a long-term increase in growth rate of GDP per person for countries which are in the steady state. Like in this second point, we are talking about developed countries. Third limitation is assumption that there is diminishing returns of capital. So in developed countries like USA, Japan, even though capital has kept increasing, the output or return on investment hasn't fallen, which is inconsistent with neoclassical model where we have said that capital deepening for developed countries should not have no impact on long-term growth rate of GDP per person. So in response to these criticisms of neoclassical model, we have made two models. First is the augmented solo model, which is just a neoclassical model, but we have added few adjustments to this. So here what we have done is we have reduced the contribution explained by the unexplained technological progress by including factors like human capital, research and development, and public investments, as we have studied in the extended production function. And the next is endogenous growth theory, which we are going to come to next. Let's start with endogenous growth model. Here, technological progress is treated as endogenous, meaning inside the model, and not exogenous. Here, the focus is to explain technological progress. So, the technological progress is explained by including research and development and human capital as factors of production. We have already discussed that research and development have high positive externalities. If an entity engages in research and development, then it is going not only going to help that particular entity, but it is going to help other entities as well. So, in this model, there is no such thing as diminishing margin returns with respect to capital. Here, the GDP per person is directly proportional to capital per person. So, let's say this is the graph between GDP per person, capital per person. So, the relationship would be a straight line with slope which we measured by a variable C. So, the GDP per person can also be expressed by this equation y equals to CK, where Y is the GDP per person and K is the capital per person. Here, the growth rate in GDP per person is equal to growth rate in capital per person, which can be calculated by this formula. S is the savings rate, C is the capital per person. This variable represents depreciation rate in economy and represents growth rate of labor force. So here we notice that GDP per person is positively correlated with savings rate and capital per person. So this model predicts that high saving rates leads to permanently high growth rate in GDP per person. And it does not suggest convergence in GDP per person of developing and developed countries. Why this is so? Because there is no such concept of diminishing margin return for capital. Higher capital also lead to permanently high growth rate in GDP per person. So we can say that this model overcomes the limitation of neoclassical model, which we have discussed regarding technology impact, savings and investment, and capital. So we have seen the three theories of growth. Now let's come to the convergence debate. Here, notice that the neoclassical model only says that GDP per person of developing countries should catch up with GDP per person of developed countries due to the impact of capital and technology. So the neoclassical model suggests two types of convergence, absolute convergence and conditional convergence. The absolute convergence says that GDP per person of developing countries catches up with GDP per person of developed countries regardless of their particular characteristics. As the name itself says, absolute. And conditional convergence says that convergence is conditional on countries having same savings rate, population growth rate, and production function. So here the name itself says conditional. Now let us discuss what has historically been seen. So there are two things here, club convergence and non-convergence step. So by club convergence we could say that these are the club of developing countries which have good fundamental factors. That's why they are on convergence path. So they have developed appropriate legal, political, and economic systems and open trade and capital flows. Basically, these purple bullet points we have discussed in the first section of this chapter only. And not in non-convergence trap, there are countries which have bad fundamental factors. Here there might be lack of property rights, political instability, etc. etc. So now let's come to a discussion about growth in open economy. First, look at the reasons why open and trade-oriented economies grow faster than the closed economies. As we have already studied that higher savings leads to higher investment, which leads to higher capital, and that provides higher output. So countries which have low savings rate could benefit greatly by opening up their economy as there will be more investments coming in, which will help in increasing the capital. So I will say this section is not highly important compared to these two, but here are the points. So an open economy can borrow land in global markets, shift resources to industries which have competitive advantage. Companies have a global market available for their products, import technology, and greater competition leads to more efficiency. Inefficient firms quit the business. So now let's come to how opening up the economies will affect neoclassical theory and endogenous growth theory. So for neoclassical theory, the major implication would be that open economies tend to converge fast. So in this whole section, we are only discussing the concept of convergence. I've highlighted the points yellow which might seem new. So as we've already discussed, for developing countries, GDP per person is lower. As a result, increment in output from each unit of capital is higher. So what investors will see is that there is a higher return on investment from investing in developing country. Now this will lead to a situation where there will be more capital inflows. More capital inflows means more investments, and more investments mean that the capital stock rises at a faster rate, and as a result, GDP per person converges of a developing country with that of a developed country. So there are few side remarks in this. So we have already studied the concept that capital account must be matched with the current account. So what happens when the economy is opened is that there is high amount of capital inflows. So these capital inflows must be matched with an opposing current account. So our current account is in deficit as we are buying more foreign machinery, equipment, etc. to produce goods. So during this phase, the growth rate due to high capital investment, the growth rate in GDP per person will temporarily above the growth rate suggested by the steady state. As you experience diminishing marginal returns of capital, investment will gradually decrease and trade deficit will also gradually decrease. At long run, the country will grow at the rate suggested by the steady state rate of growth. Now let's come to the endogenous growth theory. Here the impact is that open trade policy permanently raises the level of economic growth. So here are the various mechanisms through which open trade policies increases the level of economic growth. First is the selection effect. It says that less efficient companies exit and more efficient companies innovate and grow. Second is the scale effect. It says that producers achieve economies of scale by selling to a larger market. So, so in turn, the costs are low. And the third is backwardness effect. Less advanced countries catch up with more advanced countries through knowledge spillovers.